You think your trading job is to predict the market's next move. That belief is costing you more than you realize. I know this because I spent 8 years trying to outsmart randomness. I stacked indicators, I analyzed for hours, I tried to be smarter than the trading chart. Then I analyzed thousands of my past trades and discovered something brutal. My intelligence wasn't protecting me. It was the liability draining my trading account. In this video, I'm sharing the zero prediction system. It allows me to execute in under 30 minutes without looking at a chart again. And here's why it works. Because I admit nothing about what happens next. We will install 3 pieces. The uncertainty tax ritual that removes trading fear before you click buy. The 60-40 math law, which proves you can be wrong 6 times out of 10 and still profit. And the validation audit. It's the pass-fail scorecard that grades your rule following and never your dollars and cents. Most traders believe they are losing because they haven't analyzed enough. One more indicator, one more news article, then they'll finally know. Then they'll be safe. But here's what I've learned. Your intelligence is not protecting you. It's working against you. It was January 2017. I was tracking 8 markets, Euro USD, gold, the S&P 500, and more. My charts looked like a Christmas tree with indicators stacked everywhere. I'd spent 3 hours analyzing a single GBP USD setup. I'd check the economic calendar, I'd read the news, and I'd convinced myself that because I'd done the homework, the trade had to work. So I'd click buy, feeling smart. But the market reversed within like 2 hours. My stop loss got hit, negative $30. So I thought I needed to analyze more. And I did. 4 hours the next time, still lost. 5 hours, lost again. Now here's what I didn't understand. I was paying a tax that I couldn't see. This is what I call the prediction tax. Every hour spent predicting the unpredictable costs you in 3 ways: time, mental energy, and capital. You lose money because overanalysis creates emotional attachment to a trading position. The amateur trader believes analysis buys certainty, but it doesn't. Look, certainty in trading does not exist. 𝑻𝒊𝒎𝒔𝒕𝒊𝒑𝒊𝒑𝒕, the legendary trader and co-creator of the turtle system, said it plainly. You simply cannot know what happened next, and that's perfectly fine. The professional trader does not fight this truth. They accept it. They pay a different fee upfront to avoid the prediction tax entirely. This is the uncertainty tax. It's the psychological fee that you pay before entering any trade. You pay it in one currency. Your ego's need to be right about a specific trading move. Think of it like a concert ticket. You buy it weeks in advance. You don't know if the band will cancel or if the show will be terrible, but you pay the $100 anyway. You accept the uncertainty because the experience is worth the risk. Trading is identical. The ticket price is accepting that you might lose a specific amount on this trade. You pay that price psychologically before you enter the trade. Then you can execute without fear. In 2017, I refused to pay the uncertainty tax. I thought 3 hours of study earned me a free pass from the risk. The market sent me a bill anyway. And that is every single time. So how do we pay this uncertainty tax so that we can trade without the stress? Here's a framework that applies this principle. I call it the prepayment routine. And it is not magic. It's applied psychology structured around a core truth that fear lives in the unknown. By confronting the worst case scenario before you trade, you remove its power. So step 1, written acceptance. Before opening any position, write this sentence in your trading journal. I accept that this trade may cost me exactly then your specific risk amount. This is the uncertainty tax I am paying now for access to the opportunity. But why do you need to write it? Handwriting forces slower processing and creates a psychological anchor. Now, close your eyes. Visualize that money is already gone. Feel the loss in this moment, not later when the stop loss hits. Step 2, the panic check. If that visualization makes your chest tighten, stop. Do not trade. Your position size is too large. You have not paid the tax. But if you feel calm, proceed. You've prepaid the tax. The outcome is now irrelevant because you already accepted the cost. Paying the tax removes the fear, but it does not remove the losses. To handle those, you need to reframe what a loss actually is. I'm going to give you a number, 60%. If your trading system loses 60% of the time, meaning you are wrong more often than you are right, you can still be massively profitable. The amateur trader looks at 6 red trades and thinks, I am terrible at this. I need a better strategy. The 15th of November, 2021 was a breaking point for me. I had just closed my 9th consecutive losing trade. Over 4 months, I was down 15%. And the voice in my head kept saying, your edge is gone. You're wasting money. Quit. I felt like a complete fraud. Here I was, 8 years into trading and could not string together 2 wins. But then I forced myself to open my trading journal. I checked 4 years of historical data. There it was, 2 separate 9 losing streaks. Both times, the system recovered within the next 30 trades and went on to profit. I wasn't experiencing failure. I was experiencing the 60-40 math law. Here's the data that proves that this is not just theory. A 2019 analysis by ESMA, the European Securities and Markets Authority, tracked retail trading accounts across major brokers. And the data showed between 74% to 89% of retail accounts lost money. But here's the critical detail. The average losing trader risked more to make less, approximately a 1 to 0.6 risk to reward ratio. But the average profitable trader did the opposite. They risked less to make more, approximately a 1 to 1.6 risk to reward ratio. The difference was not the win rate, it was the maths. I wanted to think of car insurance. Insurance companies know that mathematically and with certainty that in any given year, a significant portion of policyholders will file claims. They don't panic when a claim arrives. They budgeted for it. They built the maths to handle the predictable cost of doing business. You are the insurance company of your trading. Those 40% winning trades at a 2 to 1 risk-reward ratio, those are your premium income. The 60% losing trades, those are just the scheduled claim payouts. And here's the maths that changed my trading career. We are going to walk through this slowly so that you can follow the logic. If I risk $100 to make $200 and I win only 40% of the time over 10 trades, look at what happens. 40% of 10 trades equals 4 wins. 4 wins multiplied by $200 equals $800 total won. 60% of 10 trades equals 6 losses. 6 losses multiplied by $100 risk equals $600 lost. Now take your $800 won and subtract the $600 lost. Your net profit is $200. That's how I made $200 by being wrong 60% of the time. That 9th loss in November of 2021, it wasn't failure. It was probability distributing exactly as planned. Over the next 21 trades, I won 9 and lost 12. Those 21 trades recovered the entire loss and left me profitable. To stop panicking, stop treating losses as failures. Treat them as rent. This is the statistical loss rent budget. Step 1, know your loss rate. Take your expected loss rate from backtesting Assume 60% for a typical trend following system with a 2-to-1 risk to reward ratio. Step 2, calculate your monthly rent. Use this formula. Planned trades multiplied by risk percentage multiplied by the expected loss rate equals the budgeted rent. For example, take 10 trades, 1% risk and a 60% loss rate. 10 times 1% is 10%. Now 60% of that 10% is 6%. Your budgeted rent is a 6% drawdown. So why calculate upfront this cost? Because during a losing streak, your emotional brain will say something is broken. But having a pre-calculated budget allows your logical brain to counter with data. No, this is the expected variance within normal parameters. Step 3, reframe the invoice. When I close a losing trade, I don't say, I lost money. I say, I just paid $100 of my $600 monthly budget. As long as your cumulative losses stay within that 6% budget, you are running a healthy, functioning business. You are not losing control. You are paying scheduled operating costs to access the winners. Larry Hite, who founded Mint Investment Management, had win rates below 40%, and yet he was profitable for decades. How? By ensuring that his average winner was at least double his average loser. The amateur trader chases 80% win rates with terrible risk to reward, but the professional trader accepts 40% wins with a 2-to-1 edge. This maths stops the panic, but if your trading losses persist, you have a hidden trading blind spot. I built a free Why Am I Still Losing Money diagnostic quiz to pinpoint the exact system failure that is causing them. Click the link in the description to reveal your root cause in 3 minutes. You need that diagnosis before we change your scoreboard. Have you ever skipped a trade because the last one at the same level did not work out, even though your checklist said yes? In 9th July 2021, I was staring at a GBP USD chart, a textbook pin bar set up at 1.3800, support level. Trend checked, level checked, signal checked. But my gut kept saying, no, don't do it. Why? Because 7 days earlier, I had taken a trade at that same level and it stalled. It never hit the 2-hour target. So I froze. I thought, I'm not falling for this again. I sat on my hands. 3 days later, the pound against the dollar rallied straight to the 2-hour profit target that I had intended. I watched the market hand out the $200 profit and I refused to collect it. I didn't lose money, but I failed. I failed because I let emotion override my trading system that I had spent months proving. Here's the brutal truth. If you judge your performance by whether you made money today, you are rewarding chaos. In the short term, you can make money by being reckless, and you can lose money by being smart. Mark Douglas, the author of the famous book, Trading in the Zone, documented a consistent pattern among professional traders. They are mentally disciplined to detach from individual trade outcomes. Their focus is on process execution, not single trade results. And this is not a personality trait, it is a trained skill. Here is a framework that embodies this principle: the validation audit. It's a pass-fail inspection that ignores the money and focuses solely on your process adherence. Step 1, the binary question. After a trade closes, do not look at the profit and loss. Open your trading journal and ask, did I follow my predefined plan with 0 deviation? Did I wait for the candle close? Did I risk exactly 1%? Did I set the stop loss and never touched it? Step 2, the grade. If yes to all, then write 10 out of 10 execution, success. Even if the trade lost, let's say $100. that loss is a success because you followed the process. If no, if you broke one rule, write 0 out of 10 execution failure. Even if you made $500, that win is a failure because you reinforced chaos. But why binary, 10 out of 10 or 0 out of 10, and not a scale? Because a partial credit trains your brain to accept close enough. But trading demands binary discipline. You either followed the rule or you didn't. The gray area is where accounts die. Step 3, track the real metric. At the end of each week, calculate number of 10 out of 10 executions divided by the total trades multiplied by 100 equals your validation score. Your goal is a 90% or higher score. This is your performance metric, not profit and loss. After that missed GBP USD trade, I wrote a new rule. If the checklist says yes, I execute it without any negotiation. The next time I faced that battle, I pointed to each box and said, yes, out loud, and placed the order. The trade hit my stop loss. But I wrote 10 out of 10 execution success. This is a statistical loss. System is operating normally. For the first time, a loss did not feel like a failure. It felt like paying rent. You now have the 3-piece trading system that removes the fear. The uncertainty tax prepays your psychological risk, and the 60-40 math law reframes losses as business rent. The validation audit scores your discipline and not your dollars. But here's the problem that this system does not solve. You can execute fearlessly, handle losses without panic, and grade yourself perfectly on process. But if you are picking the wrong trade setups in the first place, you'll still keep losing money. You will just feel calm about it. That's the hidden danger. Disciplined execution of bad trades. This next video solves that. It's called the TLS veto filter. It's a 3-second quality control test that I run before risking a single dollar. Trend, level, signal. 3 questions. All 3 must be yes, or the trade is automatically rejected. This filter is what stops you from taking setups that look valid but are floating in the market noise. Because most losing trades don't fail because of bad execution psychology. They fail because the setup was approved without passing basic structural requirements. Check out this video where I'll show you why most traders lose money at level and not signal, and how to fix it in 3 seconds. See you there.